All right, so for the first part of chapter 4, we are going to talk about the audit risk model. So if you'll remember from the previous chapters, audit risk is basically the risk that the auditor is going to issue an unqualified opinion. Remember, the unqualified opinion means that they're reasonably assured that there was no material misstatement. So audit risk, again, is the risk that they're going to issue that unqualified opinion when, in fact, the financial statements are materially misstated. So the problem is that we said the financial statements were good when actually they were not. Now, this involves first at the financial statement level. So that's why you see financial statement level here, okay? But this also trickles down to the individual account balance level. Remember when we did the materiality example that we looked not only at total materiality, but we also broke that down into tolerable misstatement, which was at the account level or class of accounts level. This can also trickle down to the assertions. Remember our assertions from chapter 1. This can trickle all the way down to those assertions. For example, an assertion was existence. So we could assume that inventory did exist when in fact it does not in a material way. So we have to consider all of these levels as auditors and that there is no material misstatement at each of the levels. Now this is a big picture. This is what is called the audit risk model. And we're going to focus on this right here, okay? Now, we're going to talk about each of these, and I'm actually going to move over to a different screen so that we can write some notes. But what I want you to understand from this is the audit risk model is the risk of material misstatement, call that RMM, you see it right here, okay, times detection risk. And we're going to break down each of those. So give me just a moment. I've written the same thing over here. Remember that RMM is risk of material misstatement. And DR is detection risk. Then remember that audit risk, which we could also call AR, is that risks that we said the financial statements were good and they weren't, okay? So we can break down risk of material misstatement into two parts. One is IR, or inherent risk. The other is CR, which is control risk. So now let's talk about what all of these things mean. We know what audit risk is. What is inherent risk? I like to call inherent risk gross risk. So this is the risk of material misstatement in the financial statements, and I'm going to abbreviate here, before considering any internal controls. So it is the gross risk. Before any controls, what is just the risk? Remember, we're going to look at the business entity, and in the planning phase, we're going to understand more about them and their internal controls. That's what we're talking about today when we talk about risk assessment. And we need to know how much risk there is that there is a material misstatement before we even consider controls. Now, internal controls can mitigate that risk, so they can reduce inherent risk. So I like to call control risk net risk. Okay, so this is after controls. So this is the risk that material misstatement could occur gotta scroll and not be prevented or detected by internal controls. So in other words, inherent risk is just the flat risk. What could go wrong? Okay. Control risk is the risk that's left over that something did go wrong and internal controls did not work to either prevent and or detect and correct. So this is important. Let's add that correct. Whoops. Those risks or those issues. Okay. Now, the auditor has no control over inherent risk and control risk. Those are under the control of management. They are the ones that decide what happens, what their risks are, and how to develop internal controls in response to those risks. Okay? Now, what we haven't talked about is detection risk. Okay? So I'm going to scroll down. Detection risk, what is that? That is the risk that the auditor will not detect, detect misstatements. So remember that auditors do not sample everything. Okay, we sample a portion. We cannot test every transaction, every part of every account. Because we are sampling, there is a risk that we will not detect misstatements. And even within the things that we do investigate, we still may come to the wrong conclusions. Okay, so that is detection risk. Now, as part of detection risk, right, we said one is that we didn't sample enough, right? So that is sampling risk, that we didn't sample enough or we didn't get the right sample, okay? Then we also have non-sampling risk. Non-sampling risk is the risk that we came to the wrong conclusion. And that is a part of that detection risk. Now, detection risk, auditors have control over. So with detection risk, we can determine how much we're going to sample, what kinds of things we're going to sample, how much time we're going to spend on these things. Detection risk is within our control. Now, why do we care about these things in the first place? We care about these things because in every audit, we have some sort of engagement risk. If we issue an unqualified opinion, we say the financial statements are good, and then later on it is figured out that they are not, we are exposed to both litigation issues and adverse publicity. And this happens, I think, more frequently than we would like to imagine. If you didn't sit in my internal audit class and hear about Rita Crundwell, you need to go look her up. The auditors that were over doing the audits for the city of Dixon, Illinois, were sued because of their failure to detect the fraud that she had done within the financial statements. Okay, so we don't want our audit to fail. So this is why we care about audit risk in the first place. Now, how do we use this audit risk model? Well, the first thing we need to do, number one here, is we need to set that planned level of audit risk, okay? So at the beginning of the audit, as we're doing this audit risk assessment, once we get done with that, we're going to set the level of audit risk that we're willing to accept, okay? We know what the environment is. We don't want our audit to fail. We will determine what that audit risk should be, okay? So we determine this audit risk right here, okay? Remember, these two combined are the risk of material misstatement, okay? Then for part two, we're going to assess this risk of material misstatement, which is our inherent risk. That's going to deal with the business and its environment, okay? And the control risk right here, which is going to deal with the company's response to their risks and how well that those internal controls are functioning. So what this leaves is we do not know detection risk. So we have to find detection risk. And we find it right here by taking the audit risk that we set divided by the inherent risk times the control risk. What this means is that the higher risk of material misstatement, meaning that we think there's a high risk that these financial statements are misstated, the lower our detection risk, meaning the more work that we're going to do in order to detect that material misstatement. Now that can be a little confusing, but think about it. If detection risk is low, okay, then we have a low risk of not detecting the error or the fraud. If we have a low risk, we get that lower risk by doing more work. So it seems counterintuitive, okay? But detection risk is the only thing that we have control over. And if we're worried that there is material misstatement, we need to do more work so that there is a lower chance that we will not detect that material misstatement. All right, so how do we do this? The first thing that we need to do is we're going to look at the business entity's risks, okay? We're going to take a look at what's going on. Then we're going to take those risks and we're going to relate them to specific account balances or disclosures. We're going to brainstorm. What could go wrong? Okay. Once we do that brainstorming, then we're going to assess the risk of material misstatement, which we break down into inherent risk and control risk. And we plug that into this audit model. Remember, this is planned beforehand. The audit risk is planned beforehand. Okay. And we will set detection risk. Okay. So let's think about it in these terms. We can use qualitative terms. What do they mean by qualitative terms? Instead of putting a number to it, 10%, 20%, 30%, so forth and so on, we can use qualitative terms, low, medium, high. They're using moderate instead of medium. Now you can do this for each and every account. So you will do this as a whole for the entire financial statements, but you can also do this for each account or class of transactions. So in case number one, they feel that audit risk should be very low. Remember, this is set. They've determined that risk of material misstatement here is high. So in order to get audit risk low, they've got to put detection risk low. Okay? In case number three, however, audit risk is low. There's a low risk of misstatement. Okay? There's a low risk of coming to the wrong conclusion. Risk of material misstatement is also low, so there's a low risk of misstatement to begin with. Therefore, detection risk can be high, okay? Meaning we can do less work because there is a low chance of us not detecting a problem if it did exist. Now, this is a planning tool. This audit risk model is a planning tool, but it has limitations, okay? So we got to think about these. First of all, we have a desired or a planned level of audit risk, but that doesn't mean that we're actually going to achieve that audit risk, okay? We do have times where we'll have to do additional work in order to make sure that our audit risk gets to that planned level, okay? Second, it doesn't consider auditor error. Auditors are human. They make mistakes, okay? So we have to consider the fact that the auditor made an error. Lastly, we have no way of knowing that whatever we determined that risk of material misstatement was, we have no way of knowing that it actually was the risk of material misstatement. Remember, all of this involves judgment. These are all risks that we're assessing, and they involve a level of judgment. It doesn't mean that our judgment is always perfectly correct, and that leads to a risk or a limitation of this particular audit risk model. Next, we're going to walk through the steps for the risk assessment process so that we can gain a little bit more information about how we go through the whole risk assessment.